Welcome to a Wiser Retirement podcast. Before we get started with the episode, I want to tell you about a new ebook available on our website called Buyer Beware. Why do they keep trying to sell you that annuity? This ebook covers the various types of annuities, negatives to owning annuities, and better investment alternatives to annuities. To download this ebook, you can click the link in the episode notes or go to wiserinvestor.com and you'll find it at the bottom of the page. Now on to today's episode.
Welcome to a Wiser Retirement Podcast. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith. Joining me today is Shawn Shelton, partner at Moore Ingram Johnson Steel. Shawn is primarily works in the areas of estate tax, income planning, corporate tax planning. Shawn, we've been working together for a while now.
Yeah.
And thank you for coming on to the podcast. This is your first go on the Wiser Retirement. I appreciate your time.
Thank you.
This is not billable time, is it?
No, we're not touching it.
We're about to shut this down really fast. So today we're going to talk about charitable trust, and we'll kind of branch off of that into some other things. Mm-hmm. But I wanted to create a scenario. We'll call them the Joneses because, we all try to keep up with the Joneses, right?
Right.
So the Joneses have obviously done well because everybody's trying to be them. And let's say that they have amassed an estate well above the exclusion. So when we talk about an exclusion, we're talking about an estate for husband and wife that's worth more than $25 million.
Right.
So above $25 million, you pass away. Anything above that mark today, you're going to pay, or the estate would pay a death tax.
Right. Federal estate tax at 40% of the excess. And so, that right now that number is around 25 million. It's 12.92 million per person. So for a married couple, that gets it up around 25, actually close to 26. If there's no changes in the law, there's a potential, or there is a decrease that would come into effect January 1st, 2026. And we don't know exactly where the number is going to end up because it's indexed for inflation. But basically, right now, the base amount is 10 million, and the inflation adjustments have gotten it up to 12.92. In 2026, the base amount goes from 10 million to 5 million. Mm-hmm. But you still have all the inflation adjustments, so it's probably going to end up, anywhere from 6.5 to 7.5 million per person. So then, you'd be talking about anybody with an estate over 14 or 15 million could be looking at potential estate tax liability.
And that 40%, that's a lot of money.
It's pretty steep.
Yeah. And then some people live in states where they also have a state death tax. We don't have that in Georgia.
Correct. We do not have that in Georgia. And I think there's only a few left that have that state
Northeast tax. And Northwest.
Connecticut was one of them. I don't remember the
Washington
others.
State, I believe.
Maybe. Yeah.
Hopefully you're not in that situation because sometimes those are well below the federal
right.
numbers.
Their exemptions may be different, lower,
like $1 million, $2 million.
Who knows? Mm-hmm.
All right, so we're in this scenario. The Joneses are they have assets that have highly appreciated. If I get that out right,
yep.
Assets that have highly appreciated. That'd be like buying Apple stock as an IPO in the 80s, and they sat on it, right?
Or UPS or Home Depot, one of those.
Yeah, exactly. Or even a business that has highly appreciated in its value. And then they, real estate, keep going down the list. They're very charitable. They want to help others. They have plenty of resources for themselves. And ultimately, they're coming to us and saying, hey, we know we're over the exclusion. We need to do some estate planning. What do you suggest?
So one of the options, and I guess the one that we're sort of focused on today, it was what's called a Charitable Remainder Trust, where they take some of those low basis assets and they transfer them to an irrevocable trust. And this Charitable Remainder Trust, this is in the Internal Revenue Code. There's actually form trust documents that have been prepared by the IRS. It's what's called a split interest trust, where you have a lead beneficiary who receives an income stream either for a period of years, up to 20 years, or for the life of an individual. And then a remainder beneficiary that gets it when that period ends or when that life ends. So with a charitable remainder trust, the remainder beneficiary is a charity. And the lead beneficiary is usually the grantor, the person that's setting up the trust. So they can take some of these low basis, highly appreciated assets, transfer them to the trust, and the trust itself is tax exempt. So the trust can then diversify that portfolio, sell the assets without having to immediately pay income tax on it. The income tax doesn't go away because there's also a stream of income that is paid out to the grantor. And we can do it as an annuity trust or a unit trust. An annuity trust, it's a fixed dollar amount from the trust every year that doesn't change. With a unit trust, it's a fixed percentage of the value of the trust assets, and you have to revalue the trust assets every year. So it may increase or decrease depending on the investment performance in the trust itself. So when you liquidate that portfolio and the trust diversifies, the trust itself doesn't pay income tax, but the distributions that are going out to the grantor or the lead beneficiary, those are includable in their income, and then the nature of that income depends on the nature of the income for the trust. So it's first ordinary income up to any ordinary income received by the trust, and then it goes to capital gains, and then anything above that would be return of basis that's not taxable typically.
So if we had real estate inside the trust and it was generating real estate income from rents, that would be taxed as income as the
Ordinary
income stream
income
comes out to the Joneses. But if they had stock and they sold the stock and there was capital gains, then it would come out as capital gains.
Right. So if you did kind of a mix, I guess, if you funded this charitable remainder trust with a combination of rental property and a low basis portfolio of publicly traded securities, and let's say you've got the numbers work out that you've got $100,000 distribution to the grantor. If the rental income is $50,000, that first $50,000 is ordinary income, and then if there's capital gains from that portfolio in excess of $50,000, then the next $50,000 would also be ordinary income, and that just kind of goes on until you've, if you have an ordinary income every year, then you're going to have some of that for the grantor every year. You may use up the capital gains over time.
Is there a formula for how much income has to come out?
There is a requirement that the remainder value of the trust has to be at least 10% of the initial contributed property. Okay. And when I say the present value of the remainder interest that's going to go to the charity has to be at least 10% of what's put in. So if you're putting in $1 million, the present value of that remainder interest has to be at least $100,000. The payout amount can be anywhere from 5% to 50%.
Okay.
And just you kind of work those numbers, and part of that's up to the client. A lot of times we're just trying to maximize the income, so we'll go as high as we can and satisfy that 10% test.
Okay.
If they're not as concerned about the income stream, then you may back off that a little bit and go for a higher remainder interest. And the tax deduction, you do get a tax deduction, an immediate tax deduction based on the present value of that remainder interest when you fund the trust. So you may want to,
you get a tax deduction based on the 10% of the $1 million maybe you put into it.
Correct. And, there's limitations on that.
Because the other portion could be pulled back out.
Well, yeah.
Through the income stream.
Through the income stream, you're going to get the rest of that, theoretically, over the life of that trust.
But you're not paying any more tax than if you just kept it yourself.
No. And probably if you were planning to sell it anyway, you'd end up paying less tax, or at least deferring the tax. So, if I had $1 million asset with a $500,000 basis, I've got a $500,000 capital gain that if I sell it, I'm going to pay tax on it roughly, somewhere 25 to 30% probably on that $500,000. If you put it into the trust, you can take back the income stream. You may still end up paying close to the same amount in taxes, but you may spread it over.
Yeah, that's years. True, because it kind of hides inside the charitable remainder trust until you
receive it. Mm-hmm.
Yeah, so you could delay that for up to 20 years. It sounds like.
Well, you can do a lifetime distribution on the trust, but it's just it depends on how long it takes to push all that gain out to you based on what's the amount of the annuity or what's the amount of the unit trust payment each year and what was the total gain on the assets.
And then you pass away and these assets are now considered outside your estate. So if we had a net worth of $30 million, we put $5 million into this charitable remainder trust, the Joneses, and they would receive an income stream off that $5 million. An immediate tax deduction of 10%, so $500,000 tax deduction, right?
At least, possibly more.
and then they pass away, and there wouldn't be death tax
on the assets in the trust.
On the assets inside the trust. So if nothing else had appreciated in value, then they wouldn't have any death tax at that point.
Yeah, if we get the estate below the exemption by doing that. Yes.
And when they move the assets to the charitable trust, do we have to drop our exemption in any way?
No, it's not as long as the person setting it up. So if the grantor is the one that's receiving the unitrust or annuity payments, there's no gift. There would only be a gift that you would apply to the exemption if they're naming somebody else. So if I set this up and fund the trust with a $5 million, but I name my daughter as the lead beneficiary, I've made a gift to her based on, and it's valued based on what's the present value of that anticipated income stream.
Okay.
But in most cases, the grantor, the one who's setting it up, is the one who also receives the income payments. So there's no gift at formation.
Okay. So we have $5 million inside a trust. All that money, except for the income, would be going to the charity.
Correct.
Right? Mm-hmm. If I only deducted 10%, I died the day after I signed the documents. It
didn't work as well as it could have, probably, but it's not a total loss.
Because you're saving 40% on the death tax.
Yeah, you've removed that asset from the estate, so you saved the 40%. And this kind of ties into what you and I were talking about a little before we started, that one option to try and alleviate that or replace the value of that asset that you're getting out of your estate would be to take some or all of the income stream that's generated by that charitable remainder trust.
Yeah.
Use that to purchase a life insurance policy. And if you put the life insurance policy in an irrevocable trust, the policy itself will be out of your estate. So if I take a $5 million asset and I transfer it to the charitable remainder trust and I take the income stream, and the income stream is enough to fund the premium on preferably a second to die policy on myself and my wife.
Yeah.
And I have that policy owned by a trust and it purchases a $5 million policy. Then at my death, that $5 million in the life insurance trust is available for my family, even if I die 3 days after I set it up.
Tax-free, not part of your estate.
Not included in your estate.
Yeah. And this is the only time. It took 180 episodes, Shawn. 180 episodes of our podcast for me to agree that a permanent life insurance policy might be a good idea.
Yep.
Because you wouldn't be funding that with term.
No, probably not.
And you also have to have decent enough health to get the whole life or the universal life, right?
Right. You have to be you have to be insurable, as they say. But again, and I have a background in insurance somewhat, so I may talk a little more about this than I should. But with a married couple, they don't both have to be in good health. When you're insuring 2 lives, it's easier even if one spouse is unhealthy or would be uninsurable on their own, you can still get a policy that covers both of them without it being
second to die policy.
Right. Yeah. And that's the best fit for estate tax purposes because, and we didn't talk much about this, for a married couple, you can usually defer any estate taxes until the death of the second spouse. Between the available exemption and the fact that you get a 100% deduction for property that passes to your spouse, you're not going to owe any estate tax until the second death anyways. So a second to die policy can really make sense for that reason.
So even if you're not charitable, because we're trying to figure out who's the candidate for this. Over the exclusion, I think is a good candidate. Mm-hmm. Being charitable.
I think being charitable is important. And like you said, it may not be absolutely necessary, but I think it's a harder sell for somebody that's not already interested in supporting some charitable organizations.
Yeah.
So over the exemption has a highly appreciated asset or portfolio that they may be looking to diversify a little bit, and that also has, I think, the potential for significant gain in the future on that portfolio that would just add to, if it continues to grow, it's just going to add to their estate tax problem.
Yeah, absolutely. So then there's a whole nother component to this is you might say, well, man, that's a lot of money to give to one organization. Obviously, you can name multiple organizations that would be the beneficiaries of that. But what if instead of going to that single organization, you use something like the Cobb Community Collaborative and it went into a donor advised fund?
Yep, you can do that. So, and then I believe you can set it up that way, and then you can even designate the family members or whoever you want to act as the board or the trustees for that fund, so that after your death, when the property goes to the foundation, they're able to make recommendations as far as who the grants should go to, who the actual charities that should benefit from that money.
Yeah. So now you have a family board as part of the donor advised fund. Now that money can't go to Uncle Harry and his scholarship. It has to go to
qualified charities.
Yeah, 501c3 IRS qualified charities. But that money, at that point, you're really leaving a legacy. We talk about legacy here all the time, but you're really leaving a legacy of family members taking that asset and then helping other nonprofits.
Right.
And that money could be invested still inside like a traditional, index portfolio.
Right. Family members could continue to contribute to it if they want to. So yeah, like you said, I think building a legacy of family involvement in philanthropy, and other things. So
all right, so that was quick. We got through that. Now we're experts in charitable remainder trust.
That wasn't a deep dive, but we covered kind of the basics.
How many hours does it take typically to build something like this?
For me?
Well, I'm not necessarily looking for what the cost is, but I'm more of like, how many meetings? How many? What's the person's journey to get through all this? Because you have your other estate that's a part of this too, so you have to kind of look at the whole picture. This is not a come in, set it up over one meeting. This is probably 4 or 5 meetings,
right? And I'd say this is probably not the first thing you're going to do. So the first thing we would do is we would meet and talk about what I would call your foundational documents and make sure we've got a will in place or a revocable trust. And for somebody with a taxable estate that builds in some tax planning, like I was talking about earlier, to make sure that any taxes that are due would be deferred if they're married until the death of the second spouse.
Yeah.
Get that in place along with things like a power of attorney and a healthcare directive. And this is more in the category of advanced planning that you turn to once you've done all that. And then we start looking at how can we reduce the estate if they're over the exemption to try and get it below that exemption amount. So then, it would be, we'd have probably, once we get those foundational documents, would be a separate meeting to talk about the charitable trust. How much are we looking to fund in there? What sort of asset are they putting in there? And a lot of that they're determining. I may help them kind of figure out, but there's usually, an asset that they have in mind. Like you said, that concentrated position in one stock that they bought in an IPO 20, 30 years ago that's appreciated greatly.
Yeah.
That they're worried about, if they sell it, they're going to take a big tax hit. And look at, okay, well, that's what we're planning for. This is what we're going to fund the trust with. And then we start looking at the mechanics of the trust and saying, okay, do we want it to be, is it going to be a period of time? I guess you can do up to 20 years as a fixed period, or do you want it to be for life that they're continuing to receive that payout? And then I'd say that's probably the most common. You see the unit trust or annuity trust payments coming back to the grantor for life. Then we run some calculations and figure out what's the payout percentage that we can use that will satisfy that 10% requirement and make sure we leave the 10% to the charity. And then start, put a draft of the trust together, maybe let them review it, see if maybe have another meeting to go over it and address any questions they have, and then, get it signed and get everything transferred into the name of the trust.
We're going to see, I think in the future, at least in our client base, probably really large IRAs. Is there any way to have IRA money or IRA funds end up in a charitable remainder trust?
I don't think you could do it without taking it out of the IRA first and paying the income taxes. But I think a better way to achieve charitable planning with the IRA would just be to name a charity as a beneficiary of the IRA. Because then, if you name your spouse still has the ability, if your spouse is the beneficiary of an IRA, to stretch that money out over their life expectancy and continue the tax deferral. So I think I tell people you still want your spouse as the primary beneficiary on those kinds of accounts. But if your spouse predeceases you and you're wanting to direct some money to charity, it's a good way to do it is to name a charity as maybe a partial beneficiary on the IRA, because the charity doesn't have to worry about all those tax issues that come with inheriting an IRA.
True.
They don't have to pull the money out within 10 years, then they don't have to pay tax on it. They can take it all. So you're benefiting the charity more than just an individual who receives it and has to pay all the tax on that.
Yeah, and you do have the option with your required minimum distributions up to $100,000 can go directly to charity and not be counted towards your income.
Yeah, I forgot about that. That's true.
But that's for a charitable person. If a person just believes the charity starts at home, as I've heard some of our clients say. If you're not charitably inclined, you're probably not giving away the money. Therefore, you're going to pay tax and reinvest that money back into your brokerage account or into something else.
Or give it to family or something like you said.
Yeah, exactly. So really, there's really no way to shelter that. And, because even in charitable remainder trust, you still have that life insurance option. So that you're still making your family a whole. You didn't give away their inheritance, right?
Right. Again, and it may not always be an option because I guess it is dependent on, are you in good enough health that you can get that insurance policy.
Right.
But there's a ways to, and that may be a factor in considering it, that if they're really concerned about, well, I don't want to do it if I can't get that insurance policy, then we would kind of do it in tandem, get them underwritten, see if we can qualify for a policy before we kind of pull the trigger on doing the charitable remainder trust in the first place. And I guess going back to your question about the process, we would probably also pull in, you as their financial advisor and their accountant to look at it just from a purely income tax standpoint and make sure, see if they have any suggestions or options to consider in setting it up. So that would be a concern, partly because, and I don't know if I think we did mention this. When you create and fund the charitable remainder trust, you get an immediate tax deduction based on the remainder value that's going to go to the charity. There's some limitations on how much of that deduction you can take each year based on your AGI, but you get the ability to you carry it forward for up to 5 years. So that's where the CPA would come in. We would kind of look at, well, what's your income been historically? Are you going to be able to use up all of that deduction within the 5 years, things like that.
And then hopping, same topic, different rabbit. You think about the donor advised funds. We have several podcasts we've done on donor advised funds, but specifically, you don't have to be over the exclusion to participate in a donor advised fund. That's for any family who wants to do that.
I think that's the beauty of donor advised funds is they're really easy to set up. You don't have to have a lot of money. You can do them with $5,000 or $10,000. So it's an easy way to get started in that charitable area without spending a lot of money to set something up.
So that's for really, for the most part, everyday clients, at least at our firm, that all of our clients can go and fund something like that. And what I like about it is a lot of grandparents have done it and they basically assign grandchildren. I think they realized they forgot to teach their kids to be charitable. So they're working on that next generation.
Right.
But around Thanksgiving time, they say, hey, the funds earned X amount of dollars. We need to find, 3 grandkids, three organizations that you want to support because you're kind of making you a board member of this unofficially of the donor advised fund, which I think is neat to see that process. So let's talk about, let's go really big here for a minute. And let's say that we're well over the exclusion. At what point do you just create your own family foundation?
And I was thinking about that too. That is kind of an alternative to the donor advised fund, but it does take more significant assets. I think, if you're over the exemption and you're charitably inclined, I don't know that there is a specific number, but those are more expensive to set up. You're forming an entity. You got to apply for tax exempt status with the IRS. There's annual filings and maintenance related to a private foundation. So, I'd say $1 million or up probably to even think about that. It probably. Yeah. But the benefit is, the donor advised fund, you can involve the family, but they're not getting compensated. With a private foundation, it's a corporation. And it has a board of directors that can be compensated. And there's additional requirements on a donor or on a private foundation. You have to make grants each year equal to 5% of the value of the assets. And like I said, there's even though it's not paying taxes, there's still IRS filings that are needed every year.
Public and private foundations.
And most of the
time, classifications, right?
And most of the time, what we would be talking about would be a private foundation that it's all the money's coming from one individual or one family to create this charitable entity. And then the family stays involved, like I said, acting as the board and directing those annual grants that are made. So,
yeah. And those can live
forever.
Very, very, very long time. I'm on the board up at Berry College on the Board of Visitors, and I think time flies, especially as I get older. It just moves faster. But
I know
it's within the last 5 years. I know that the Ford Foundation had done a lot of repair to the buildings that Mr. Ford had originally built on the property, which is pretty cool. Is that maintaining his legacy, literally his vision and Martha Berry's vision, being able to then come back and maintain that, like literally the rock on the side of the building, which is pretty cool. But you don't have to have Ford kind of money necessarily to have a private foundation.
No, I don't think you need, tens of millions of dollars. It can be done.
Right.
And theoretically it could be done with less than $1 million, but I just don't think there's a cost benefit analysis there as to
the donor advised funds now just make it so easy.
Right.
It's hard for me to believe that you wouldn't want to do that. But in a private foundation, if you wanted to give money directly to someone to go to school,
well, you kind of have to avoid that. There's still limitations on that. So you can't set it up, and primarily for the benefit of individual family members or things like that.
No. But if you want to start your own scholarship to something, you could just do that, right?
Right. You could.
You have less criteria than you do in the donor advised fund, as long as it's not self-benefiting.
Right. And I think you still have, so even if you're doing stuff like that, if you're a private foundation, you still got to be making grants to other charities. That's primarily what they're kind of just a pass through that
Gotcha. Which is the public ones, you can give it to individual people. Is that
well, or there's, and we're getting into stuff that I don't know as well as I should. So
I've been a part of a couple of smaller private foundations, and I know that that's something that we had to change.
And there's a, I think a point where, like I said, a private foundation, partly it's about where the money's coming from. A private foundation is usually created and funded by a single person or a single family.
Right.
When you get into a public charity, that's where you're doing more public fundraising and you're getting a large portion of your donations from the general public. And then you have another one that I don't know much about, which will be a public operating foundation, or I'm sorry, a private operating foundation, where it's a private foundation, but it does engage in some more of those direct charitable activities.
So ultimately, there's a lot of charitable options for people, even especially over the exclusion, to keep the money out of the government's hands and put it into the hands of people who actually need it, but just take some forethought and some planning.
But also maintain a little control. And I guess we didn't talk too much about that, but with the Charitable Remainder Trust, the grantor, again, the person setting up that trust, a lot of times can act as the trustee. So they're managing those investments within the trust while they are receiving the income distributions, and have a little bit more control. Or, I guess control may be the wrong word. They don't have complete control over it, but they can still manage how it's invested.
Yeah.
And they've got to make those payments every year. There is some work involved sometimes, again, with the unit trust, you've got to be able to value assets every year. There's different options for hard to value assets where you can do a net income CRT, where if you're putting in something that's, illiquid, and I guess the classic example would be valuable works of art or a business or something like that, where you set it up where the payout is based on the net income generated. So in those initially, until that asset is sold, there's very little coming out on distributions. And then when it's sold, you kind of make up for the missed distributions and just keep going from there.
Right.
There's other variations where it can flip from a net income type situation to a typical CRT upon a charitable remainder unit trust upon the occurrence of some event. There's, and that's the kind of thing that as part of the process, we can sit down and talk about what's going to work best. Is it going to be a straight charitable remainder annuity trust or a straight charitable remainder unit trust?
Yeah.
Or are we going to do one of those other options? And a lot of that would depend on what's the asset they're looking at to fund this vehicle.
Thank you. We could sit here and talk for probably hours on all different kinds of legal topics. But let's wrap it here. Shawn, if people want to work with you, how do they contact you?
You can get to me. My direct office phone number is 770-795-5077, or email sgshelton mijs.com.
Thank you for your hard work and certainly your loyalty to Wiser clients. So I don't think we've had one single complaint.
It's my pleasure. I'm glad to hear that. I hope it stays that way.
5 stars.
We'll do our best. Yeah. Thanks for having me.
Thanks for being on here. We have a couple episodes if you want to learn more about estate planning. Episode 120, finding the right estate planning attorney for you. Episode 116, are you striving to leave a purposeful legacy? We also have our YouTube channel called A Wiser Retirement. What is the role of a trustee and to prevent family conflict in legacy planning? These are all in the show notes. You can direct link there. Thanks for listening to today's episode. If you're interested in learning more about Wiser Wealth Management, want to schedule a consultation, meet with one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com, or you can click on the link in the episode notes. Thank you, guys. See you next week.
Thank you.
Thanks for listening to a Wiser Retirement podcast. We hope you enjoyed today's episode. Make sure to subscribe wherever you're listening. That way you don't miss any new episodes. We'd also appreciate if you could leave a rating and review. If you have any questions about anything that was discussed today, head to wiserinvestor.com and reach out. This episode was produced and edited by Ken Hoadley.